Picture this. You hand over your house, your actual house on the canals of Amsterdam, and in return, you receive one single flower bulb. And at the time, you feel like you got the better end of the deal. It sounds completely insane, but nearly 400 years ago, this really happened. This is the story of tulip mania, the first financial bubble in recorded history. And by the end, you'll see a pattern that is repeated in every single bubble since, right up to today. Let's start with how crazy this got. In the 1630s, the most expensive thing in all of Holland wasn't gold, and it wasn't land. It was a flower bulb, the tulip. At the very peak, a single rare bulb sold for around 10,000 guilders. To put that in perspective, a skilled worker earned about 300 guilders a year, so that one bulb was worth more than 20 years of wages, more than a grand house on the canal. So, how on earth does a flower become that valuable? First, tulips were brand new to Europe, brought over from the Ottoman Empire in the 1500s. Nothing else looked like them. Second, the Dutch at this time were the richest people in the world, with real money to spend on luxury and status. A rare tulip in your garden became the ultimate status symbol, visible proof of your taste and your wealth. So demand was enormous. But that alone isn't enough for a bubble. The real question is, what made certain bulbs so rare? And here's the fascinating answer: a virus. The most prized tulips had dramatic, flame-like streaks across their petals. These were called broken tulips. For centuries, no one knew why. We now know those beautiful patterns were caused by a virus, the tulip-breaking virus. The virus made every infected bulb unique, a one-of-a-kind living artwork that no grower could reproduce on demand. But there was a twist. The same virus weakened the bulb. So these prized tulips were fragile and multiplied slowly, which made them genuinely, permanently scarce. Now, combine huge demand with real scarcity, and prices start to climb. At first, only wealthy collectors and serious growers were trading bulbs. But as prices rose, ordinary people noticed, and they wanted in on the easy money. Crucially, they began buying bulbs not to plant and enjoy, but purely to sell them on later at a higher price. And that is the engine inside every bubble, the greater fool theory. You knowingly overpay, betting that an even greater fool will pay you even more. Here's where it gets really strange. Tulips only bloom for a short window, and the bulbs die if you dig them up at the wrong time, so people often couldn't trade the actual flower. So instead they started trading written contracts, promises to buy a bulb in the future. Paper, not flowers. These contracts changed hands in taverns, sometimes 10 times in a single day, all through the winter. The Dutch had a perfect name for it: windhandel, wind trade, because no actual bulbs were ever moving. People were trading thin air. And remember, this was happening with no safety net whatsoever. There was no stock exchange, no regulator, and no clearinghouse standing behind any of these trades. There was no deposit and no margin. It was just two people, a promise, and very often a few drinks. Every buyer simply assumed they'd always be able to sell to the next person for more. The entire structure was built on one thing, and one thing only: confidence. By the winter of 1636 into 37, the price chart had gone almost vertical. Even common bulbs, which had once cost very little, were now fetching hundreds of guilders. People were selling land, livestock, and their life savings just to get a piece of the trade. And almost everyone shared the same belief, that the rise would simply never stop. Then came February of 1637. At a routine bulb auction in the city of Haarlem, something happened that had never happened before. The bids didn't come. For the first time, buyers simply failed to show up. One likely reason: an outbreak of plague in the city had people staying away. Word of that failed auction spread fast, and the confidence the whole market stood on shattered within days. Prices collapsed by an estimated 90% or more, almost overnight. The dream was over. So who actually got hurt? The people left holding bulbs, or those paper contracts, now owed money for something worth almost nothing. And many of them were latecomers, ordinary people who had jumped in last, chasing the easy money everyone else seemed to be making. Interestingly, total ruin was less common than you'd think. Many contracts were simply settled for a small fraction, or quietly torn up, and the courts refused to enforce them. And there's one tale that captures the madness perfectly. A sailor who reportedly ate a priceless tulip bulb, mistaking it for an onion. Now it's very tempting to look back and assume only foolish, gullible people could have fallen for this. But that's simply not true. Smart, wealthy, well-informed people drove these prices up too. Because here's the trap. From inside a bubble, paying more always feels rational. The rising price keeps proving you right up until the moment it doesn't. And that illusion, that comfortable feeling of being right, is exactly what makes bubbles so dangerous. Now, I have to be honest with you, because this is where most retellings go wrong. A lot of the famous, dramatic story comes from a single book written in 1841 by a journalist named Charles Mackay. Modern historians who dug into the actual records found that the mania was real, but far less catastrophic than the legend claims. It did not crash the Dutch economy. The Netherlands remained the richest nation in the world for decades afterward. The lesson absolutely survives, but here's a bonus lesson. Always question the most dramatic version of any story, even this one. So strip away the costume, and Tulip Mania reveals a skeleton you will see again and again. A believable story. Easy money, euphoria. The phrase, "this time is different." And then the snap. Tulips, the South Sea bubble, the crash of 1929, the dot-com boom, crypto, same shape, just a different asset each time. The thing being traded changes completely. Human psychology never does. And this is why a 400-year-old flower story actually matters to you. At some point in your investing life, you will feel this exact pull. The fear of missing out while everyone around you seems to be getting rich. The warning sign is simple. Ask yourself, is the only reason to buy this that it keeps going up? The antidote is just as simple, even if it's hard. Ask what the thing is actually worth, not just what the next person might pay for it. Knowing the pattern won't kill the temptation, but it gives you a fighting chance to step back when it counts. Let's pull it all together. 1. A single rare tulip bulb once cost more than a canal house, over 20 years of a worker's wages. 2. Prices rose mainly because people bought only to resell, the greater fool engine. 3. Trading moved on to unregulated paper contracts, the wind trade, settled in taverns. 4. In February 1637, the buyers vanished and prices collapsed around 90% in weeks. And 5. The real lesson, every bubble shares the same shape. Learn it once, and you can recognize it for the rest of your life. If this story finally made the idea of a bubble click into place for you, then you're going to love where this series goes. We tell the story of the market, its history, its mechanics, and its lessons, one episode at a time. So, hit subscribe, tap the bell, and I'll see you in the next one.